Today is the 14th of February 2022. My name is David Hickson, and in today's market update we're going to be taking a look at the Nasdaq and also the S&P 500. We had several comments on last week's market update requesting the Nasdaq. It's been a little time since we last took a look at it, so that's what we're going to be doing today. Let's start with a big picture view, because there is something very interesting that is happening between the S&P 500 or the SPX and the Nasdaq, as you can see on this chart. In particular, the interesting discrepancy between the two different instruments has to do with the magnitude of the March 2020 trough. I've been presenting this analysis for many months now in the S&P 500 and speaking about the very big magnitude trough that formed in March of 2020. I believe it was a trough of at least 54-month magnitude, possibly even 9-year magnitude. And of course, we had the previous 18-month cycle trough occurring here in December of 2018. So let's quickly take a look at roughly the same zoom scale on a chart of the Nasdaq. Here it is, and you will immediately notice a difference between the two analyses, and that is that the December 2018 trough in the Nasdaq, according to this analysis, is the big magnitude cycle trough of 54 months magnitude, as opposed to the March 2020 trough, which in terms of this analysis is only an 18-month cycle trough. So that's a really interesting difference. And the reason for that is because the Nasdaq did not actually reach down to lower lows for the March 2020 trough. The lower low was in the December 2018 trough. And so naturally we would be inclined to position a bigger magnitude cycle trough here in December of 2018. Of course, an analysis is a more complex process than simply positioning the trough at the lowest price. You have to look at the breakdown of all the shorter cycles and so forth. So I won't be dwelling on that in this video because there's quite a lot to discuss there. But it is an interesting difference between these two analyses. Now, I know there are some Nasdaq analysts who are positioning the big magnitude cycle trough, the 54-month cycle trough, or maybe even 9-year cycle trough over here in March of 2020. And that is by no means wrong. That could well turn out to be the correct analysis. As you probably know, if you've been watching these market updates for any length of time, I don't worry too much about the specific details, particularly in terms of the placement of those longer cycle troughs. Because what is more important to me is to determine a level of confidence in a particular analysis, and my level of confidence in the magnitude of the March 2020 trough is of at least 18 months. I believe that was at least an 18-month cycle trough. It could have been a 54-month cycle trough, or it is interesting to consider the possibility that the 54-month cycle trough in the Nasdaq occurred in December of 2018. What are the implications of that possibility? If the 54-month cycle trough did indeed form in December of 2018, then what does that mean to us? It doesn't mean very much in the shorter term, as we will see in a moment when we zoom in. And that's another important point that I would like to emphasize in today's video, that the difference in the analysis at a longer scale, a bigger magnitude cycle, doesn't have a huge amount of implication for us when we are considering what we are expecting to happen over the next few weeks. However, there is one very interesting implication of the fact that the big magnitude cycle trough might have formed in December of 2018, and I'm going to zoom in to demonstrate that to you. Let's zoom into that scale there. As I have mentioned in many previous market updates, there are of course 3 18-month cycles that make up each and every 54-month cycle. That is the nominal model that Hurst defined over 50 years ago. And if you don't understand the concept of the nominal model and why there is a 54-month cycle and an 18-month cycle, I would encourage you to download the 10 core concepts document that I will put a link to in the description below this video. The important thing is that there are 3 18-month cycles within each 54-month cycle. And in the Nasdaq, we are seeing that we are probably currently in the third 18-month cycle. What does that mean? Well, the first 18-month cycle is generally a very bullish cycle. The second 18-month cycle should be slightly less bullish, which immediately brings into question the magnitude of this trough, because cycle number 2 was more bullish than cycle number 1. So we have a little bit of an anomaly. But if I continue this process of thinking through the cycles, you will see that the third 18-month cycle is, of course, expected to be the least bullish of the 3 18-month cycles. And so the fact that this cycle has seemed to turn bearish is not really an anomaly, given the possibility that the 54-month cycle trough could have formed in December of 2018. And so that makes for a very interesting difference, in my opinion, between the Nasdaq and the S&P 500. As you might know, if you've been watching these market update videos, we are facing a bit of an anomaly in terms of the most recent cycles since early October, which has had a fairly bearish shape. In the S&P 500 it's been fairly neutral, but in the Nasdaq it has been distinctly bearish, as you can see, because we had a lower trough in January than we did in October of last year, indicating, of course, that we have a bearish cycle shape. And so this possibility that the 54-month cycle trough actually occurred in December of 2018 instead of March 2020 is an interesting one, because it does open the door towards a fairly bearish cycle elapsing into the next 54-month cycle trough, which is, of course, expected early next year, according to this analysis. Now let's just quickly switch back to the S&P 500 chart and discuss that same anomaly that I have just mentioned. If we zoom in on roughly the same kind of time frame, you can see that according to this analysis, we have our big magnitude cycle trough in March of 2020, as I've discussed many times before. And you will also know there is the possibility of an 18-month cycle trough over here in October, which we're going to take a look at in a moment. Or there is the possibility that the 18-month cycle trough formed recently in January of this year, as discussed in previous market update videos. That's a fairly questionable suggestion, and I know there are many analysts that disagree with that possibility, but it's certainly a fairly interesting possibility. Here is the big problem, is that we would expect a very bullish 18-month cycle. That would be the first one, and that would be cycle number 1. And then cycle number 2 should be less bullish, but it shouldn't really be turning bearish quite so soon in the cycle. I'm assuming now that the trough of the 18-month cycle occurred in October, and so we have witnessed a bearish cycle since October, and that is an anomaly, as pointed out in previous market update videos. And I know there are some analysts who say that because of that anomaly, that means that the 18-month cycle trough couldn't possibly have formed in October because it is an unacceptable anomaly. In my opinion, it's not unacceptable. It is simply an anomaly such as does sometimes arise in the markets. As a matter of interest, when discussing this March 2020 trough in the S&P 500, if we take a look at the low price over here in December 2018, and then if we zoom in to the price action at the time of that March 2020 trough, then you will see that, in fact, price, where was that low price? 23.39, there we go. So price only actually dropped below the low price of December 2018. For 1 day it closed below it, and 2 days it closed below it, and then it bounced back up again. And so calling that a lower trough is a fairly subtle thing, because price only dropped below the level of the December 2018 low for a few days, which is another interesting possibility. Is it possible that because of fundamental interaction and panic that was sweeping across the world at the time because of the pandemic, is it possible that prices slipped a little lower than they might have been inclined to purely on the basis of the cycles that are influencing those price movements. That's an interesting suggestion and certainly an interesting possibility. But let's zoom in and take a look at what is happening now. And seeing as we're looking at a chart of the S&P 500, let's keep looking at that. This is the option that has the 18-month cycle trough over here in the third week of January of this year. And you can see that, in fact, let me display the FLD, the 20-day FLD, which of course we like to keep an eye on in terms of monitoring price interaction with that FLD. Here is the FLD on the basis of this analysis. I should point out that in this analysis the cycles have been running long because of the perhaps impossibly long 18-month cycle that might have formed a trough in the third week of January. Price only just came over the 20-day cycle FLD over here in the first week of February, I think that was. And of course, that would be labeled, if this analysis is correct, that would be labeled an A category interaction. As mentioned in the previous two market update videos, I would expect price to then find support at the level of the FLD. You can see that what has happened in overnight trading today, and I'm recording this before the US markets actually open today on Monday, you can see that prices dropped down below the level of the FLD, and so it is not managing to find support at the level of the FLD. So that does certainly raise some question marks. We would expect price to find support at about the level of the FLD. Nevertheless, we are certainly expecting a 20-day cycle trough to form according to this analysis. And so it is quite possible that it might slip below the 20-day FLD, form the 20-day cycle trough, and then bounce up again. But this is one of those moments where we need to watch the markets really carefully to see what they are doing. Let's take a look at the other analysis in the S&P 500 before we go and take a look at the Nasdaq. And here is that analysis with the 18-month cycle trough, of course, in October of last year. And you can see that here is the trough on the 24th of January. Here is the whisker of the 20-week cycle, indicating that this possible trough over here formed at a time when it was reasonable for us to expect an early 20-week cycle to form. Price then crossed the 20-day FLD in what would have been labeled an A category interaction if and only if this turned out to be an early 20-week cycle trough. Again, we would expect price to come down and find support at the level of the 20-day FLD if this analysis and this sequence of logic, in other words, positioning the 20-week cycle trough over here, was correct. As you can see, the FLD is in a slightly different position because the length of the 20-day cycle is different in this analysis because the cycles have been running short as opposed to running long. Price has dropped down below the 20-day FLD, fairly clearly failing to find support at that level. That is a bit of a warning sign, indicating that our assumption that the 20-week cycle trough might have formed over here in this analysis could well be wrong. If that is the case, then what is happening now? Well, as you can see, Sentient Trader has not yet positioned the 20-week cycle trough because it thinks there is simply not enough evidence that that trough has formed, even though this low price point did form within the range of reasonable time in which the 20-week cycle trough could have formed. If this is the case, then what was this interaction with the FLD? Well, price crossed above it, but we would have to label it, if the 20-week cycle trough has not yet formed, as a G category interaction, where price is normally expected to find resistance at the level of the FLD. It didn't find resistance, it popped above it, but it didn't go very far, and now it has dropped down again, which could potentially be an H category interaction. So we have a bit of a dilemma at the moment in terms of what is actually happening in the market. I should point out that a dilemma similar to this very often happens around the formation of any of these cycle troughs, particularly when a cycle trough is possibly forming early. You have to be careful of jumping into a trade prematurely on the basis of price possibly crossing above the FLD, as I've mentioned in the past 2 market updates, I believe. You have to be very careful of assuming that this is an A category interaction when it could turn out to be a G category interaction. Which interaction is it? Which one of these 2 possibilities is correct? We still cannot say. And that is the interesting thing about what is happening in the markets at the moment, is that we need to keep a close eye on what is happening and see where the next trough forms. If price forms a trough higher than the level at the 24th of January, then crosses up above the FLD, then we will confirm this as an early trough of the 20-week cycle, or possibly the 18-month cycle if that analysis is one that appeals to you. If, however, price continues to drop down and forms a lower trough, then that would finally be our 20-week cycle trough. I'd like to point out these bar counts over here. Some very interesting bar counts on our chart. 136 days have elapsed since the early October 2021 trough. 136 days is the average length of the 20-week cycle as discovered by Hurst 50 years ago. So we are at exactly the acceptable or the average time for the 20-week cycle today. So it's going to be very interesting to see how price behaves. If it forms a trough right here and at a higher level, then of course in our cycle phasing we will in fact position the 20-week cycle trough at the earlier trough position. If, however, price drops down a little lower, then we will position the 20-week cycle trough there. Now let's quickly take a look at the Nasdaq. And here you can see that in the Nasdaq, the 18-month cycle trough almost certainly formed at the beginning of October. The analysis is very, very similar to the analysis in the S&P 500. Here is our nest of lows for the 20-week cycle trough. And if we count the number of bars that have elapsed since this October trough, you can see there have been 133 bars, and so in theory we might have another 3 days or 3 bars to go until the average length of the 20-week cycle is achieved. However, again, notice this whisker, this line extending to the left of the circle for the 20-week cycle, showing that this trough that formed on the 24th of January might possibly be a 20-week cycle trough forming in the markets. Of course, our interaction with the FLD works a lot better if that was the 20-week cycle trough, because there would be our F category interaction. Here is our G category interaction where price found resistance at exactly the level of the 20-day FLD. Our H category interaction as price dropped down into this trough. And so we are faced with exactly the same anomaly that we have in the S&P 500. Is it possible that the 20-week cycle trough formed early over here in the 3rd week of January, or the final week of January? If that did happen, then this would have been an A category interaction as price crossed above the FLD, and we would have expected price to find support at the level of the FLD. You can see that, as is the case in the S&P 500, it has failed to do so. The fact that it has failed to do so is a bit of an alarm bell. It's a warning to us that indeed the 20-week cycle trough might still lie ahead of us. And so again, we are going to be watching this market with great attention to detail to see exactly where this 20-week cycle trough is going to form. Does it still lie ahead of us, a few days or a week or 2 ahead of us, or has it indeed formed at the end of January? I do hope that you found this market update useful and interesting. If you have any questions, please put them in the comments below the video. I look forward to hearing from you.